Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, this week was anything but quiet. Let's start with the big one. What's happening in the Middle East?
Yes, this was the week geopolitical risk jumped off the page and hit the markets hard. Overnight, reports emerged that Israel launched strikes on Iranian nuclear facilities. While tensions had clearly been rising, this escalation was still a shock, and markets reacted as you'd expect. Brent crude surged almost 10% in early trading, its biggest move in months. Now here's the real kicker. Oil had actually been one of the key disinflationary forces underpinning the recent cooling in global CPI prints. That story may now be over. With energy prices back in play, volatility is creeping back into inflation expectations, and we're seeing equity futures sell off across the board, down 1 to 1.5% as we record this. So geopolitics isn't just noise this time. It's macro-relevant, inflation-linked, and potentially central bank altering.
Let's pivot to the US, a very different kind of disruption. ICE raids and business sentiment are both making headlines. What's the story?
This one is flying under the radar, but it matters. The Immigration and Customs Enforcement Agency is targeting 3,000 arrests a day, an aggressive crackdown that's starting to visibly impact sectors reliant on undocumented labor. Construction sites are stalling. Agricultural supply chains are fraying. Small and mid-sized businesses, many of them already fragile, are now feeling the squeeze. It's showing up in the data. The quarterly confidence survey for U.S. mid-sized companies saw its sharpest drop in a decade, excluding COVID. And it's not just business sentiment. We're seeing it in consumer behavior too. Companies like Coca-Cola, Colgate, and even Wingstop are reporting declining sales among Latino consumers. These enforcement policies aren't just political, they're economic.
It seems like the inflation debate just keeps evolving. Tariffs, oil, immigration, now bananas.
Yes, literally bananas. Prices were up 3.3% month on month in May. It sounds trivial, but it's emblematic. Bananas are ultra-sensitive to supply chain stress, and they're now flashing inflation. We've spent weeks talking about lagged effects from tariffs. Well, this is what the early stage impact looks like. Perishable goods get hit first. As port delays and shipping frictions mount, we'll likely see similar price pressure creep into other parts of the basket. So while headline CPI remains contained, just 0.1% last month, the underlying components are beginning to stir.
Let's stay with inflation for a moment. What's your read on the latest CPI print?
The May CPI was a bit of a Goldilocks read. Soft headline, firmer core. Headline rose 0.1%, and the annual rate ticked up to 2.4%. But core CPI, excluding food and energy, remains sticky at 2.8%. Housing, particularly shelter, was the main driver again. Interestingly, some of the categories we'd expect to be tariff impacted, cars, clothing, actually fell in price. That suggests the real pass-through is still coming. The Fed will take comfort in the muted headline, but core inflation and geopolitical noise mean they'll tread carefully. Markets still expect a cut by September, but the path just got a bit bumpier.
What about global investor flows? Are we seeing any clear preferences?
Yes, and they're fascinating. In May, U.S. equity funds saw outflows of nearly $25 billion. Europe, by contrast, had its strongest inflows in 4 years, $21 billion. And emerging markets saw $3.6 billion of inflows, driven by a weaker dollar and a more dovish ECB. It's a reminder that capital is mobile and increasingly looking for policy clarity and valuation upside. Europe is benefiting from falling inflation and a more benign macro backdrop. EM is back on the radar, and the U.S., despite its dominance, is starting to see fatigue.
That's it for this week. Stay tuned for more insights next time.